Sage here for kalkinemedia. Please subscribe to the channel and press the bell icon to be notified of the latest videos. Thanks for joining us for this trending topic. How much were the CBA shares worth when floated? Banking is seen as a key driver of economic growth anywhere in the world, and the banking system is to the economy as a circulation system is to the human body, and banks lend money either to companies or to individuals. In both cases, the credit line helps in economic growth, stimulating demand in the economy. For instance, a company takes a loan of 100 million Australian dollars from, say, XYZ Bank, a fictitious name of course, and the company that produces cars uses this to enhance production. To ramp up the production, the company hires more people, and these people will end up spending the additional money they earn at the company, thus enhancing demand. Also, since the production is increased, there are now more economies of scale, and the car prices would automatically come down, getting affordable for more and more people. It again stimulates the demand. Now imagine an individual ABC who takes the loan from the same XYZ bank, and he takes it to buy a new home, thus further increasing demand. And this increase in demand has a multiplier effect with upward mobility that ultimately leads to economic growth. So, in the above story, the customer remained the king of demand-driven growth. However, the kingmaker was the bank. And there may be tens and thousands of banks across the globe, and some are huge when we look at their asset base. In 2020, global rating agency S&P published a global market intelligence report of the 100 largest banks in the world, and of the top 5, as usual, 4 were Chinese, with only JP Morgan Chase & Co. from the US making the cut. On the 45th slot in the list is Australia's largest bank, the Commonwealth Bank of Australia, on the ASX as CBA, and with the asset size of 1.06 billion Australian dollars as on date. With primary focus on the retail lending, especially home loans, the loan book of the bank currently stands at 792.1 billion Australian dollars. Backed by the strong financial performance, the bank's shares are currently trading at a lifetime high of 105 Australian dollars and 75 cents per share. Over the past decade, the shares of the bank have grown by 114%, which translates into a compounded annual growth rate of 8% every year for a decade, which saw the world crawling out of a financial meltdown, an economic slowdown, a once-in-a-100-year pandemic, and a recession. And this makes us inquisitive about the beginnings of the Commonwealth Bank and how its share price has grown since. When and at what rate was CBA listed? To begin with, the bank was a government-owned entity until it was converted into a public company with share capital on the 17th of April 1991. And thereafter, as the government drew down on its holdings, the bank was privatised in 3 stages. In middle of 1991, the bank made an offer of its newly issued shares to the public. At this stage, the government divested 30% of its stake from the bank, represented by 230 million shares. And the shares were issued on the 12th of September 1991 at an issue price of $5.40 Australian, which could be called as its floating price. And for the early investors who have held the shares till now, the bank has lived up to their expectations, giving them 10% compounded return every year for 3 decades, during which the world saw 3 recessions. So when did the government further divest from the bank? Again, in October 1993, the government moved to truncate its stake in the bank to 50.4%, and this would mean parting with 178 million shares, which were finally listed on the 1st of November 1993. The bank and the government followed a dual issue price, and this time $9.35 Australian for retail investors and $9.60 Australian for institutional investors. The compounded annual return in this case is almost 100 basis points lower, at 9% for the retail shareholder and 8.9% for the institutional ones. The remaining 50.4% stake of the government was offered to public in 1996. In July 1996, the government made a public offer of its remaining 50.4% shareholding in the bank. As part of the connected clauses of this offer, the bank agreed to buy back 100 million shares from the government. The buyback price was fixed at $10.01 per share Australian, leading to a payout worth of $1 billion Australian dollars being paid to the government from the bank. The public offer and the buyback were completed on the 22nd of July 1996, and the government offered 399 million shares to the public, for which the investors paid $6 Australian per share on spot, with the remaining instalment of $4.45 Australian to be paid 1.5 years later. Investors were entitled to 3 dividend payouts in this 1.5 years. Does the bank have DRP in place? Interestingly, the dividend that an investor gets from the CBA can be reinvested back into the bank, as the bank had a dividend reinvestment plan, or DRP, in the place. The DRP allows shareholders to reinvest all or part of any dividend paid on their shares into additional shares instead of receiving the dividend in cash. Thanks for joining us in this report. If you like this information, please like, share and comment on the video below, and subscribe to the YouTube channel. Press the bell icon to be notified of the latest videos. And for more information and regular updates, please head to the website kalkinemedia.com. And this is Sage for Kalkine Media.